Welcome to this week's Q&A. I've got a good generic question this week from one of our viewers in Sydney, and he's asked me, what should I be concentrating on to develop a successful property investment strategy? So, it's a very broad-based question clearly, but I guess the best way of looking to answer something like this is to say, what are some great guiding investment principles in general, and seeing how do you apply those to a specific asset class. In this instance, he's looking at Australian residential property. So let's look at it more empirically. As we all know, most people, if they're investing, will generally use leverage. So they'll go and borrow money when they're buying higher cost, substantial assets such as property. They'll go and seek a loan from a bank, and if they're a client of ours, they'll generally try and maximize that loan and take a loan for 85% as long as they don't have to pay mortgage insurance to the bank. Now, that's quite a sensible approach as long as you're comfortable with that level of debt and can comfortably service that loan repayment amount, and give yourself some buffer. Because as we've just seen over the last 12 months or so, there have been significant increases to the official cash rates, both in Australia, America and other developed nations. So we've got to bake in, as it were, some buffer to make sure that we can keep these assets. And that comes back to the investment principles. I think the most important guiding principle should be that when you're developing an investment portfolio in property, make sure that you structure it in a way that you can potentially keep that forever, because that may be a good outcome in many ways, which we can discuss at another time. But unless you need to sell an asset for a specific reason, then there's probably no need in incurring all of the costs associated with that transaction, that sales transaction, and potential tax impost from the profit you may make from that investment, and give that away for no reason. So then it's important to really make sure that you know that you can keep these assets through thick and thin as financial situations change over time, and continue to grow upon those, because at the end of the day, that's what's going to help you. You're going to have an increase in your balance sheet, and you're going to have an increase in income that's being derived from these assets over time as rental incomes increase. And generally, if you look at history, they'll increase by at least CPI over an extended period of time. So really important, I think, to say we're not going to trade in this asset, because obviously it's a lumpy asset. It's expensive to move in and out of, so it's not a trading asset. It's an asset that you'd seek to keep for a long period of time. Make sure you can afford to keep that. Make sure that you keep abreast of your debt portfolio so you can create as many efficiencies in that as possible. And that's something else we've just seen over the last, say, 3 years during the pandemic, where most of our clients have availed themselves of very inexpensive investment loans that the banks were offering, either on 2, 3, 4 or 5 year fixed interest period, that's going to stand them in very good stead to enable to increase their portfolios and to manage that cash flow very effectively. So really important to stay abreast of that. Don't just sort of let things sit and forget about them, but make sure that you review your situation on an ongoing basis, or have somebody help you with that process and make sure they're evaluating your situation on an ongoing process, both in terms of the investments and in terms of the debt that's associated with building that investment portfolio. So don't try and create too much movement there. It may create more heat than light, and try and spend the time and the research on obtaining good quality assets to start with, and making sure they're in sought after locations where the supply and demand equations and the macro drivers, I suppose, of those markets, like population growth and employment growth and infrastructure growth, continue to be tailwinds in relation to how your particular investments may fare over the long term. So Look, if this has been of interest to you, then please subscribe to our YouTube channel and click like. And if you need any potential assistance with developing your own strategy, please don't hesitate to reach out, email us or phone us, and we'll have somebody get in contact with you. I'll see you at next week's Q&A. I'm Andrew Unterweger.